So Brandon Ladoff is the Senior Vice President and the head of their research effort and the large company Director of Research. An interesting background, he grew up in Coral Springs, Florida. Anyone from that neighborhood? He attended the University of Florida. Kate, are you going to jump up and, yeah? Brandon achieved something that I've never seen before, a CPA who graduated summa cum laude with the highest honors. From there, he went on to get a law degree at the University of Pennsylvania and also do studies there on corporations, and he focused on corporate finance. And then came around after some time at Price Waterhouse and also a law firm. And he came to Polen Capital about 4.5 years ago and found just the right fit for him. And their culture comes through loud and clear in the presentation. And now please give a warm welcome to Brandon, our lead-off star for the night.
All right, well, hello everyone. Thank you, Phil, for that introduction. Quite possibly the nicest introduction I've ever received. And on the slide deck, I'll have to share that with our marketing people because they would be thrilled to hear that it's the best deck that you've seen in the past 24 years. But thanks again for having us. It's great to be here. Polen Capital, we are based here in Boca Raton. Phil asked if we could come in again, share our story, how we invest, maybe provide a couple of examples of some of our core holdings. We're happy to do that, especially in the local community. So thanks again. I think we have about 15 minutes here or so, followed by some Q&A. Won't be able to get through all the slides I have here, unfortunately. Might have to go through some of these quickly, but hopefully we can tackle any questions you have about the material and otherwise during the Q&A, if that works. All right, so first, just a little bit about Polen Capital. Again, we are a global multi-strategy asset manager based right here in Boca Raton. We focus on global equities, and more specifically, we're looking for great businesses that we think can grow really nicely over the next 5+ years. For us, it always starts with our mission: preserve and then grow client assets to protect their present and enable their future. It's very important to us. It's at the center of everything we do. We're always thinking about preserving capital first. Any investment we make, we have to feel like we're not going to lose money, and then we'll think about how to grow assets from there. Of course, it doesn't always work out that way, but that's how we go in. If we feel like there's meaningful downside risk in any of our investment candidates, it's not going to be have real potential for us at the end of the day. Just a few quick stats on the firm. As of March 31st, we had about $13 billion under management. Today, we're just over $14 billion under management. Over 40 employees based out of our Boca office as compared to under 20 4 or 5 years ago. So we've grown quite substantially in terms of assets and employees over the past 5 years. Very proud of that, of course. And we've also grown in terms of our product set. So for about 25 years, we had one product. That was our focused growth strategy, focusing on large cap companies based predominantly here in the U.S. Coming up on about 30 years, soon, close to a 30-year track record here. That launched in 1989. We launched our second product, a global growth large cap product, in 2015. It's coming up on a 3-year track record. And then just this year, we're very excited about our large cap international growth strategy that we launched. And separate from that, a lot going on in Poland, but separate from that, we just announced in June that we opened our second office in Boston. Hired someone by the name of Tucker Walsh, very successful investment professional, mostly within the small cap space. So he's going to be leading our first initiative into the small cap space. He's going to launch very soon here a U.S. small cap product. And the plan is to build out a small cap team similar to the way we've built out a large cap team here in Boca. And that's going to be a completely separate, independent investment team from the one we have here in Boca Raton. Here are some numbers on performance across our products. I've highlighted our longest term performance for each product in red. So you can see our focused growth product, 28-year track record there. Since 1989, we've done just over 14% annualized returns while taking less risk along the way, something we're very proud of here. Just to frame that in dollars for you, gross of fees, if you'd invested about $25 million with us in 1989, it would be worth, again, before factoring in fees, nearly $1 billion today. with a B. So that just shows the power of compounding consistent growth over time. Our global growth product is coming up on its 3-year track record, as I mentioned. Very happy with returns so far, about 500 basis points of annualized alpha there. And our international growth product, still a baby, just launched this year. And we don't emphasize short-term performance here, but we are happy with how it's performed out of the gate. You can see not even 6 months here, it's actually up over 20% year to date as compared to just under 14% for its benchmarked MSCI ACWI ex-US. Here's our investment team. There's 10 of us here in Boca Raton. I won't go through all the names and bios. The key point is we have one global analyst team at Polen Capital that works across all 3 of these products. We feel like that's a key advantage for us, people doing great research on businesses across the globe. We think it brings a lot of research synergies to our team, so learning more about U.S. businesses based on the international work we do and more about international businesses based on the U.S. work that we do. And hopefully I'll have some time to be more specific there. In terms of our investment philosophy, this is probably the most important slide in terms of what we do and how we do it. There's a lot on the page, a lot of bullet points, so I'll just hit on the very high level. Number 1, we run concentrated portfolios at Polen Capital. Our focused growth product has only about 20 names. Our global and international products have larger universes that they cover, so it's about 30 names in those products. We want to believe that every single one of our holdings is our very best idea. We've found pretty consistently that if you look at our focused growth product, once we think about what would be our 30th or 40th best idea, we see a meaningful drop-off in quality there. So we've always felt that we'd just be adding risk without providing any additional benefit just for the sake of diversification if we went down that path. So that's never been something that we've wanted to do. So we focus only on what we think are the highest quality franchises in the world. These are companies that we think have some of the heaviest competitive advantages out there, the things that really differentiate these businesses, protect these businesses from competitors that are inevitably going to try and come in and take market share. We're looking for that very high quality and that wide moat, as a lot of people refer to it as this industry. We're also very long-term focused. So in our focused growth product, nearly 30 years now, we've only owned just over 100 companies in total over all that time, holding each of them for about 5 years on average. And we've had the conviction to stay long-term focused because we do a lot of work around the competitive advantages around these companies. Why is it that they're differentiated and protected? Once we can get comfortable there, and we think it's rare, we don't think many companies in the world are actually that protected, then we can get more comfortable that the company can grow over a very long period of time. So we want to stick around for so long as our thesis remains intact. And for us, that's been about 5 years. And then finally, we think about risk management differently at Polen Capital. A lot of people hear concentration, they hear growth manager, then they immediately think, how do you protect on the downside? Our downside capture has actually been really strong. The way we've managed risk has been really strong. We've found that if you're only focusing on the highest quality companies, you can debate how fast they're going to grow over time, but for us, it's hard to debate that they're going to become larger over time. So yes, if we're wrong about how fast these companies are going to grow, it might not turn out to be as good of an investment for us, but as long as the company continues to grow and we're paying reasonable prices for these businesses, we feel like the downside protection there is quite strong. And that's what's played out over the past, nearly 3 decades now. Here are a couple of our core holdings, type of business that we're really looking for. In our focused growth product and global growth product, Facebook is a core holding. And in our global product and our international product, Tencent is a core holding of ours. So Facebook is based here in the US, Tencent based in China. And I'll talk through a bit more of those in detail. Facebook is first example I'd like to highlight of a company that we really like, think has very good prospects over the next 5 years or so. I'm sure most of you have heard of Facebook. Most of you probably use the service. Some great stats on Facebook. Nearly 1.3 billion people today are using Facebook every single day, spending about 50 minutes or so between Facebook and Instagram on those platforms every single day. That's more than the average person in this country spends exercising or caring for their pets. A little bit sad, but very powerful for Facebook in terms of how engaged their user base is. So what this essentially means, Facebook is blocked in China, so that market isn't open to them today. If you line up every single internet user around the world outside of China, about 1 out of every 2 of those people are using Facebook every single day. Not just using it, but using it every single day. So again, a very powerful statistic. So what we look for when we're analyzing a business is, number one, is it operating in an attractive space? So for Facebook, it's an advertising business. Almost all of their sales come from advertising. And what we see is a $600 billion advertising market, very large, not growing that fast, but the portion of it that Facebook addresses is growing very fast. And this is led by Facebook. So that $600 billion is split between offline, TV, magazine ads, those type of things, and online, which is online ads on platforms like Facebook. The online portion is about $200 billion of the $600 billion and growing much faster as people spend a lot less time watching TV, flipping through magazines, and a lot more time on the internet. And we think that's a long-lasting trend, a big secular tailwind for Facebook. And then it keeps going from there. So within online advertising, you have search ads, the ads you typically see on Google, where people have high purchase intent. You might be taking a trip, click on a link for a hotel on Google, and then actually book a room. So again, a lot of intent there. And then there are brand ads. So think about a Nike. They might show an ad for their latest pair of sneakers. It's not a direct response type ad, but you see it, you see the pair of sneakers, and maybe the next time you go shopping, you remember it. Even if you don't realize it, it makes you more likely to purchase those sneakers. That portion of the online advertising market is growing a lot faster than search ads right now. And the reason is, historically, those types of ads that I mentioned, that Nike ad, have been a lot harder to measure and target to people who are relevant to Nike. But Facebook, with all of their data, the 1.3 billion people visiting every single day, they have a lot more data than anyone else on who's using the platform. That's very valuable for companies like Nike. And then, again, it keeps going. So within brand advertising, mobile is taking a lot of share from PC. Facebook is inherently mobile. Most of us use it on our smartphone. And within mobile, video ads are taking share from everything else. And I'm sure a lot of you have seen in your newsfeed videos representing a higher percentage of that content. Video ads and videos in general are a lot more engaging. They command higher prices. So multiple layers of secular tailwinds that we think can enable many years of growth. That's the first thing we look for. The second thing, and actually where we spend most of our time, is the competitive advantages around the business. What really differentiates the company? Why is it that in 5, 10 years we think Facebook will still be very hard to compete with? There's a lot of things here. I'll just highlight a couple. The biggest one is the network effects in the business. So 1.3 billion people, most people all of us know, are friends and family, and people connected to them are already on Facebook. So the next person that's not on social media yet is much more likely to join Facebook because that's where all of their connections already are, as opposed to a new entrant that doesn't really have those connections. When you would go into their app, let's say on your phone, it would feel more like a ghost town. There isn't really that desire to join that type of platform. So the next person joins Facebook, they add more content, makes the next person more likely to join, so on and so forth. So that's what we call network effects. We think that's really powerful for Facebook. And then secondly, data and marketer relationships. I talked about all of the data that Facebook has. That's an increasingly important resource in this world. So you have all these marketers around the world who want to get out to customers. They want to know more about who they can market to. So Nike can go to Facebook and say, I want to serve an ad for our latest pair of sneakers to only people 21 to 25 who have expressed an interest in running within the past 3 months. That's a very powerful thing. It might make the people they serve those ads to spend more time with that ad and spend more money with Nike, which allows Nike to want to market more and pay Facebook more for that same ad because more sales are going back to Nike as a result of showing that ad. And then just tools, measurement tools, reporting tools. Facebook has gotten very close to large and small businesses, helping to make sure that they have all the tools they need to be able to measure these ads more effectively. Another key advantage for Facebook. So then we see those things in the business. Then we want to make sure there's a long runway for growth. Facebook is all about the number of ads they show to users and the price they charge marketers for those ads. The number of ads Facebook can show grows as more users join the platform, as those users come, as a higher percentage of those users come daily, and as those daily users spend even more time per day on the platform. And then ad prices grow largely as a result of ad relevance and targeting. So again, as these ads become more targeted and relevant to us, marketers want to pay more for that same ad because it's driving more sales back to them. We think these are long-lasting trends. Again, multi-year growth algorithm here for Facebook. It's a big reason why it's a core holding for us. And valuation, we think, is reasonable. Can go into more detail there in the Q&A if you'd like. But based on how we think they're going to grow, and then compare it to what we have to pay, we see very nice returns over the long term. And then the second example is Tencent. Maybe fewer of you in the room are familiar with Tencent. This is a company based in China. I like to think of them as Facebook on steroids. So basically what they have is an app called Weijin. They have a lot of different assets, but the big one that I want to highlight is an app called Weijin. It means WeChat in English. It started off as a basic messaging app, more like a WhatsApp or a Facebook Messenger, which Facebook owns. And then over time, the genius of Tencent is they convinced these users to do more and more within the messaging app. So they wrapped in a social media platform called Moments, which is very similar to how people use Facebook here. They wrapped in a game center. So now within the Weijin app, you can press a button and play a lot of different online games in China, which is a very big growing space as well, developed both in-house by Tencent and also by third parties that are then downloaded from within their app. And they've connected with various partners in China to offer a huge, wide-ranging number of services. So for example, JD.com is a very large e-commerce platform in China, number 2 behind Alibaba. They partnered with JD.com. Now there's another button within the Weijin app. You click it. Now you're within JD.com without leaving the app. You have an opportunity to purchase goods within JD. So engagement is really high for Tencent. They operate within the very attractive online advertising space within China, very similar to all of the growth prospects we see for Facebook within that market. And then they operate in a number of other attractive markets like the online gaming space. Globally, the online gaming market is over $100 billion, growing very nicely as people play more games online and these games become more engaging. And within China, it's also a very attractive market. China is actually the largest gaming market in the world, growing very nicely too. And Tencent has really nice advantages in terms of in-house development, the talent they have there, the experience, and also distribution advantage. They actually control some of the largest Android app stores in China. So they have huge influence into what games get downloaded through their app stores, which is a powerful thing. So very similar to Facebook, we see a very attractive space. We see very similar competitive advantages for Tencent, a very nice long runway for growth, similar to Facebook, and again, reasonable valuation when you look at what you have to pay for this growth. So 2 companies that we think are very well positioned for the next 5+ years. In terms of global research synergies at Polen, I touched on this earlier, but using Facebook and Tencent as a good example, we invested in Facebook in mid-2013, around $35 a share. We did a lot of work around the online advertising opportunity, the social media opportunity for Facebook. Tencent, I mentioned, has a social media asset within Weijin called Moments. And within the past couple of years, they started serving ads within Moments, building a very similar advertising business to Facebook. So really understanding Facebook helped us better understand that part of Tencent. And then for Tencent, well, for Facebook, I should say, they acquired in 2014, I believe, WhatsApp, which is a messaging platform. And now they're building out Facebook Messenger. We needed to better understand the strategic rationale for those acquisitions and building out those assets. And I mentioned how Tencent has Weijin, which started as a messaging app, and we see how they grew it into a robust platform. So really understanding Tencent helped us better understand Facebook, and we see a lot of that around our team. And again, that global research, we think, is a huge asset for us. Real quick on our different portfolios. Here's our focused growth portfolio. We invest across the growth spectrum. We'll have companies that we think will grow faster over the next 5 years, like a Facebook. We'll have companies that grow a lot slower than Facebook, but still grow nicely overall, like a Nestle, that provide ballast in the portfolio, tend to protect more capital on the downside. Downside protection is very important for us. Here's a chart that shows what Polen Capital did in our focused growth product during the tech bubble boom and burst, and then during the financial crisis. So if you look at the tech bubble, for example, we're the dark blue line at the top, and I know this is hard to see, but basically we went down a lot less in the tech bubble than both the Russell and the S&P. So we recovered and got back to where we were before the bubble burst in 3.3 years. If you compare that to the S&P, it was just over 6 years. If you compare it to the Russell, it took the Russell 1000 growth 12 years to recover from where it was pre-tech bubble bursting. That is huge because the quicker you can get back to break even where you were beforehand, the quicker you can compound off of that base that you were at previously. So downside protection, having a great downside capture ratio has been a big source of our outperformance here, and it's something we focus on a lot. Global growth products, same thing, same core investment philosophy. We invest across the growth spectrum, just a good number of international companies in this portfolio. That's the difference between this and focus. And then in international, again, investing across the growth spectrum, but all international companies, of course. All right, so that's all I have in terms of Polen Capital, what we do, how we do it, a little insight into specific names we invest in. Happy to answer any questions you have. I don't know if it's structured with Q&A now or at the very end.
No, Q&A now.
Okay.
And then when both presentations are complete, we'll have a final Q&A as light bulbs will go off during the evening.
All right, perfect. Yes.
How has the growth of passive investing affected your investment process or how you market yourselves?
Sure. So the whole active versus passive debate, I think, is affecting all active managers. We are actually happy about what's going on with active versus passive. And the reason is, if you look at active manager returns, most managers do not beat their respective indices, right? That's the reason why this whole debate is raging right now. But we're very confident in what we do at Polen. We think we are a 1%er, top 1%er. Really like how we think we're going to perform over the very long term. So we think this is essentially going to weed out a lot of lower quality managers out there, and we think the world needs that. So we've been able to grow very nicely through this whole thing. Our assets under management were in the 4 or 5 billion range back in 2013, and now we're closer to 14 billion. We think performance will drive assets, will drive survival, if you will. So if we don't perform, if we underperform consistently, we shouldn't be able to grow as a firm. If we outperform consistently, I feel like we should be able to grow. The important thing, I think, with passive investing is you're getting the average, right? So the average in academics is maybe a C. I don't think anyone goes out there and raises their hand when they first start getting into school and says, I want to get a C. In investing, I think it's very hard to go out there and say, I just want the average. There are always going to be great active managers who are going to beat the index. The question is, can you find them? So the biggest challenge for consultants, for example, who allocate a lot of funds in this world, is they're having trouble finding great managers. But again, we feel that if we consistently perform, people will find us, and those assets will be there. Yeah. Thanks.
Can you talk about the front end of your investment process? Do you run screens? Do you read sell-side reports? Do you have a grassroots type of in-house effort?
Sure. So we do a lot of different stuff. We are always running screens. There are certain things we need to see in a business, such as decent growth, high returns on capital, solid balance sheets. You'd be surprised, but a lot of companies in the index don't meet even that. So we'll run screens to weed out a lot of companies. That's one on screening. Two, we use sell-side research, but more for hard data. So more for things like industry data when we're studying an industry. We do not rely really at all on opinions coming from the sell side. So for example, when people are on the sell side, there might be some people on the sell side here, when they're recommending stocks, saying that they like a company, they don't like a company, we don't really pay attention to that. We use our own team and our own judgment there. But we will use the real data, the actual data that they provide oftentimes in reports. And then we source ideas in a number of different ways. So we're going to a lot of conferences. The research we do on a lot of companies that we're already looking at lends itself to other ideas. A lot of times we find other companies based on the companies we're already looking at. It can come in a number of ways, just based on reading, talking to management teams about things they're seeing in the market, things that they think are interesting. Yeah, a lot of different ways. Bill?
Yeah, I've always loved history and also culture.
Yeah.
My background is somewhere between a cultural and a social anthropologist before coming into investment. And it's striking the inflection point looking at your record when your founder, I think, died somewhat unexpectedly.
Yeah.
And also at a time of turbulence in the markets. And we shrunk down to 260 million, I think it was.
Yep.
12 years ago, something like that. And then the way you've been able to come back. Another thing that I've noticed is, Jim Ware, in Focus Consulting, and the focus on building a culture within your organization. That was my interest 40 years ago in graduate school, trying to ascertain the cultures, the values that would drive success rather than, somebody that was supposed to be a genius. And we're finding out with most of the most successful companies, that's the driver. And also, what's striking about your handout of information is the transparency, the lack of paranoia or defensiveness, the openness. So a lot of values there that you guys have been through some training as a group. And now instead of having half a dozen or 10 people, you've got 46, is it, on the team?
Yeah,
How do you
40,
manage to
yeah,
build
43.
that and sustain it in a world that is supposedly changing so rapidly? So much media assaulting us all.
Sure. I always wish we could talk more about our culture because I do think it's so important. It's something that people don't talk about enough in this industry. Our culture is all about unity, being on the same team, no egos. I think it's something you have to work on every single day. I should have mentioned this. As director of research, one of my primary responsibilities is actually making sure our analyst team is trained the way we want to train them, that they're thinking about investing the way we want them to be thinking about investing, that they're thinking about teamwork and being part of a team rather than themselves and egos. It's a big part of what we do. So again, I think it starts at the top, and it's something you have to preach and work on every single day. For us, we're a close-knit group. We're away from Wall Street. We're in quiet Boca Raton. We all like each other. We all want to work together, and there are no egos. So if you look at how our analysts are compensated, for example, at Polen Capital, it has nothing to do with, I got this name into the portfolio and it appreciated by this much, as compared to my peer who recommended this name and it didn't do so well this year. We think very long-term in terms of how we invest. We think very long-term in terms of analyst performance. So instead, we think about total contributions to the team. It can be a bit intangible, but we're looking for what did the analysts do in a lot of different areas in terms of how they contributed to our culture, of course, how they contributed to team-wide research. The most important thing an analyst might do for us might be looking at a company that they don't even cover, and they identify some issue that nobody else saw, and it made us think about that issue more closely. Maybe we get out of the way because we underappreciated a certain risk. So something like that would be very highly valued at Polen Capital, whereas at other firms, people might be incentivized in a way where they might spot something with a company they don't cover, but they might not even want to surface that because they want to see their peer in a sick way not do as well as them, because then there's more for them to receive at the end of the day when bonuses come around and everything else. So there's a lot of different things we do, but the most important thing is aligning everyone around the team in a lot of different ways to make sure that they're focused on firm performance and doing the best we can for clients.
Seems to be working in basketball these days.
With Golden State?
What exercises do you do to create the we feeling? Do you have, sports activities or games or?
We have a lot of athletes in the office, but no sports activities. What we'll do is a lot of team-wide meetings, a lot of firm-wide meetings. We like to talk about other people who we think have been very successful and how they've done it. There's usually a common thread with these people. There usually aren't big egos. They usually want to take very much a team-based approach. They think about the long term, not their short-term performance and me. Yeah, there's a lot of different stuff we do. Another thing that I love about our office is we have something called our why wall that has literally pictures of a lot of our clients, and it's in the kitchen. So every day we have a kitchen in the office. Everyone comes in the kitchen to eat lunch every day. Every day, everyone in our office is reminded of who we're managing money for. And again, in this industry, we find that gets lost way too easily. You get focused on, again, yourself, what you've recommended. Is it in the portfolio? Can I hold on to this name? Because if I have 5 names in the portfolio, I might get compensated better. It doesn't work like that at all at Polen. So there are a lot of little things that I hope add up to a lot that we do consistently. I know you've had your hand up before. Oh, yeah.
No,
Final question in this segment.
all right. Going back to the passive versus active thing, right? One of the things I've noticed is a lot of, with the move to passive, and not just passive, but like smart beta, kind of like quantitative indexation, like a lot of times you're having a holding and you don't understand why it's moving so much, and what ends up happening is that it's part of this index or that index. And given that you guys have your, you know, your very set way of doing it, like how much do you guys look at whether most of, you know, whether you have too much of a concentration in a certain factor or a certain index in your portfolio that regardless of the fundamental performance of the company might get affected by fund flows in and out of these quant strategies because you just happen to carry a certain profile of a company or a certain profile of a stock and you're concentrated in those kind of companies.
Sure. So we fully acknowledge that what's going on with passive investing and smart beta, which we think is silly, that a lot of this can add to volatility and have some interesting impacts on the market. That said, we don't think at all about our weighting in certain sectors, for example, or how owned our companies might be or anything like that. We just want to stick to studying the business, thinking about how we think it's going to grow over time, and then based on what we have to pay, do we think we can generate mid-teens returns for our clients over time? If we think we can get there based on what we have to pay now, and let's say certain things going on with passive investing causes more volatility, certain share price comes down a lot. I know we were talking about this earlier. That's just more exciting for us because we were already excited about the returns we were going to get at time of investment. Now the stock's only cheaper, right? So we think our return should only be better from there. But I do think, I can't prove this, but I do think everything that's going on in passive investing right now can be pretty dangerous because what you have is basically the market locking in relative market caps. So if some company now has a $50 billion market cap, and based on the fundamentals, it shouldn't. Say it should really only be in reality a $30 billion market cap company. The market is basically locking in that overvaluation. And at some point, we feel like that has to correct. So we'll see how that plays out in terms of what actually happens. But yeah, we don't think about that at all in terms of how we invest. There's some more hands up. I don't know if we have.
We'll come back
Okay.
to questions after the next presentation.
All right.
Stay on schedule for the people that have someone breathlessly waiting for them to arrive home.
Yes, understood.
But wonderful presentation. Thank you very
All right.
much. And I'm proud to say that in my iteration the last 12 years as program chair or president, we've had the consulting firm, Focus Consulting, Jim Ware himself and his colleagues here 8 different times to do presentations. And when they do, we don't get a large turnout, but we get a large turnout of people like Brandon and Polen Capital that understand the significance of culture and how difficult it is, especially with people who are super bright, like the folks in this room. We have a tendency to want to be in our little, cubby hole and be in the silo, and also a little bit of paranoia. So it's important to break down those barriers, and communicate to have success. So fascinating presentation. We're also very pleased tonight with our second panelist. We've been able to establish a relationship with First Trust. Culturally, I guess you could say, does anyone here work with First Trust or familiar with them? They're become increasingly known for their ETFs and their unit investment trusts, a firm that was founded about 30 years ago by an individual in Chicago. In doing my due diligence, 10 days, 2 weeks ago from a sick bed, I was able to determine that, and I had seen presentations by them twice in the last year on general topics. One was on the political outlook last October, which was very well done. So quality people. So somehow I got the connection thanks to our wonderful president who passed it on to our secretary who wrote a eloquent letter, and then they called me as the program chair, and answered all the right things. Fundamental research, not primarily momentum. And then I got introduced to their Director of Research, Senior Vice President, John Erickson, who is a charter holder. He started out being merely a degree in computer science from the University of Illinois, Champaign-Urbana, and then an MBA from the same place. Worked for Price Waterhouse, among other places, before coming to First Trust and being the person who's responsible for security selection on many of their products. He's a member of the what has been the Chicago Analyst Society, and I think they're changing their name soon, or was that a rumor, to CFA. And we're very pleased to have him here with us tonight, along with his colleague Sean Moriarty. So they're not all Swedish or Norwegian at First Trust. In fact, I found the 4 people I spoke to, 3 of them had names like Jim Murphy or Brendan Mahoney. It was delightful to talk to. So an interesting culture, and perhaps on St. Patrick's Day we'll have the team come by. Please welcome John Erickson, who will give us a macro perspective.
Thanks, Phil. How's everyone doing? First of all, you guys run an incredibly efficient meeting. If Chicago did that, I'd probably attend 10 more meetings. It's more of a distance thing. That's our headquarters in Wheaton, Illinois. It's about 25 miles outside of Chicago, so it's hard to make meetings, as I'm sure some of you have similar issues here. The last time I gave this speech was about 3 weeks ago. It was in Sacramento, in Las Vegas, and I was the warm-up act for an 85-year-old gentleman named Alan Bean. Anyone know who Alan Bean is? He's the 4th man on the moon. So I'm glad that we have 2 kind of research guys here, and it's because I don't think anyone really remembered what I said after the man on the moon came up and talked. So little different environment. The Fed raised rates today. It was nice to see that the volatility wasn't real high. It seems like we're kind of getting used to this process. Overall, the climate's fairly positive for stocks. Unemployment's low. What are we at? 4.3. Inflation's below 2, maybe too low. We're down to 1.7. Growth is not spectacular, but it's steady. The flip side of that is because of the good conditions, stocks aren't cheap. They're relatively expensive. 18.5 times earnings. So what I like to do is kind of tell you where we've been over the last year or two, kind of talk about valuation. I worked 4 years in valuation services for Price Waterhouse, so I'm a value guy. When I got hired at First Trust, my first product forays were into sector unit investment trusts, technology, financial, so I like to look at the market through a sector lens, so we'll do that as well. And then we'll go ahead and kind of decide whether stocks are expensive or not right now. Fair enough? Good, because that's what I'm doing. All right, so let's go back to 2015. Anyone remember that far back? It was a tough year for money managers, tough year for advisors, tough year for clients. And the main reason was the worst thing you can do as an advisor is have a flat market or slightly positive market and provide a negative return. Just people hate that. You can underperform 2 or 3% if the market's up 20%. If you're down 20%, you can underperform 2 or 3%. People really don't notice. But if you're negative and the market's positive, that's bad. That's what happened in 2015. Orange bars are the market cap weight of the S&P 500 and the Russell 1000. So market cap weighted. S&P 500 equal weight was actually down 2%. The difference was even bigger as you go down the food chain and go to smaller stocks. It goes from 1 to -4. So most managers weight their portfolios more equally than they do market cap weighted, and this was a problem in 2015. See, 2016, it got better. First of all, the returns were positive. That's good. You can see the equally weighted, the market cap weighted indexes were about 12%, both S&P and Russell. The equal weighted indexes were better, 15 and 16. The breadth of the market was better. Small caps outperformed large. It was easier to outperform the market, and that's what happened. Where are we at this year? Right now, the market cap weighted index is right around 10%, and the equally weighted is at 8. So we're kind of flipping back the other way. In fact, well, I'll cover that in here in a minute. If we go to growth versus value, we've got large, mid, and small, working from left to right. Dark blue is growth, orange is value, light blue is mid. I apologize for my Illini colors. You're going to see a lot of orange and blue. But in each size category, growth greatly outperformed value. In fact, we had this phenomena that people kind of gave an acronym to, the FANG stocks, Facebook, that Brandon just talked about, Amazon, Netflix, and Google, now Alphabet. And what was happening is we kind of went into an earnings recession, kind of late 2015, going into 2016. The market always looks ahead. And what the investors were doing is they were kind of going and gravitating to the final stocks that still had decent growth. They were kind of abandoning the stocks that didn't have growth, going into growth. So you see this tremendous outperformance. Well, guess what? We've got kind of the same thing going on this year. Growth is greatly outperforming value. I'll show you valuations in a minute. And in fact, one of our sales guys, Sean doesn't know this yet, but on Thursday, wanted to know if we could bring a unit investment trust with the FANG stocks. And he wanted to add Apple, so F-A-A-N-G. And to me, that's a sign that that's kind of breaking up. In fact, Friday and Monday, we've kind of had the opposite. We've had money moving out of tech. Money's kind of moving into financials, and I think that's healthy. We want a more broad market. Here's 2016. It was healthy. Value came back, and you see mid and small outperforming large. So nice, broad, healthy market. All right, so where are we going as far as style boxes? This is kind of a busy slide. The orange bars are estimated 2017 PE. I like to look forward, not backwards. The market doesn't care about backwards. It cares about forward. The blue bars are 3-year earnings per share compound annual growth rate. And I used to use 5-year estimated long-term growth rates by the market, by sector. The problem is those are averages of analysts in those sectors, always way high. So now I use this 3-year estimate that's more by economists and portfolio managers, and guess what? Still too high. People are optimistic. I mean, look at those numbers. Who would take 10, 12% on large caps and 17, 18% on small caps next 3 years? I'd lock that in right now, right? That'd be pretty good. The point of showing this is just kind of show PE ratios versus growth rates. And in particular, you can see the mid caps. You've got similar growth rates and earnings forecasted, and yet the PE ratio is much higher on the growth side. And that's typical. PE growth rates are normally higher. But what's unusual is the earnings growth is about the same. So at least in the mid-cap section, there's a lot of value relative to growth in the value portion. In the small caps, it's probably about right. But if you look at small and mid versus large, the PEs are a little bit higher, but the earnings growth is even more higher. So I'd be willing to argue that there's some value in mid and small cap going forward, just strictly on valuation. Now, you can get into like how things are working as far as earnings growth and so on and so forth, but just by valuation, there's probably some value in small and mid. To take a one step forward, further, price to book is a measurement that we use a lot, whether it's just stock picking in our unit investment trust or in our AlphaX ETF. It's one of our main factors. It has predictive power over a long period of time. And typically small caps trade at a discount to large caps as far as price to book. In fact, over the last 10, 11 years, it's been about 82%. You can see that we're a relatively low range here. We keep kind of bouncing off 72. We haven't broke 70 in the last 10 years. And I'm willing to bet that we're going to catch up here at some point. So small caps, looks like there's value there, whether you're looking at price to earnings or price to book. So we'll see. Definitely some value there potentially. Let's talk about last year. Last year was a tale of two halves. The first half was kind of messy. If you remember, we had kind of a pretty big drop in commodity prices right at the beginning of the year, and there was some panic. The Fed maybe shouldn't have raised. Pretty interesting times. But if you look at the returns, for the first half, you'll notice that energy materials are towards the top half. There was a huge recovery in those areas that came from extremely low levels. The other sectors that are up there are what I call the burst sectors. It's bonds, utilities, real estate, staples, and telecom. Those are kind of your non-volatile, kind of risk-off sectors. And those kind of led the way because people were nervous. They were nervous about Brexit. They're nervous about the world economy. And you see at the bottom, financials, mainly because interest rates weren't going up. And tech didn't do well either, or healthcare. Kind of interesting. Second half, totally different. We got past Brexit. We got past the election. I'm sure that didn't help the first half. And you can see it's an extremely healthy market. The cyclical areas really outperform: financials, tech, industrials, energy materials. And you can see the burst sectors kind of on the lower half. And then healthcare. What happened with healthcare? Kind of a political football, right? I mean, depending on what side. You had Mylan, you had Valiant, a lot of issues there. Add it all up for the whole year, and again, you get kind of mixed results. Financials recovering. You see the burst stocks in general low, but then utilities and telecom did quite well because they did so well in the first half. And one thing I find interesting is consumer discretionary and consumer staples both low. Pretty high PE ratio areas. We'll show that in a few minutes. But I consider that the Amazon fact, the pricing power of the internet has really helped the consumer be able to get low prices and kind of hurt stocks in those sectors, with the exception of Amazon, of course. We're going to come back to that. All right, so where have we been? 10 years in sectors. S&P 500 at 7. Not great, but not bad, considering we had that little recession in the middle. If you look at sector performance, I told you I was a sector guy. Tech, healthcare towards the top, kind of higher risk sectors, low, high cash, low debt, high returns. You expect those to outperform. Look at consumer discretionary, consumer staples. Pretty high, kind of weird with that big recession in there. Energy materials underperformed just because commodity prices haven't done much in the last 10 years. And then luckily, none of us are in the financial sector, right? Yeah, that was the worst performing sector. The good news is it gets better. We go out 5 years, so well past the recession. Look at the returns, 15% on the U.S., S&P 500. You've got your more cyclical sectors, your growthy sectors, let's say, on the top. Discretionary but not staples, healthcare, financials. And then on the bottom, you've got energy, materials. Again, commodity prices not come back. And then you've got your lower volatility, low risk, telecom, utility staples, kind of where they should be. Up, but not as much as the market. Let's go to 1 year, dial in a little bit. Tech has just gone crazy over the last year. Earnings have been good. Financials are still recovering. Industrials have done quite well. Energy falling behind, and you can see kind of the risk-off sectors lagging the market. Year to date, we've kind of had some question about our growth. The Fed's backing off on interest rate hikes. So I think investors are a little bit nervous. You can see tech has done really well, led by some of these bigger FANG-type stocks. But you can see utilities and staples doing well also, just because people are nervous about growth. Why is energy down so much? Anyone know? It's just simply a price function. Energy prices, the oil was at about 54 at the beginning of the year. Now we're at 45. Natural gas is actually at 370. We're below 3 now. So huge declines in energy prices, bringing down energy. All right, let's go back to sector ranks. This is just a really crude exercise we use to try to determine valuation going forward by sector. Very crude. It's a multi-factor model. A lot of our products use multi-factor models to determine what we like and don't like. There's 4 factors. First one is just estimated PE ratio going forward. The lower, the better. So you can see telecom's got the lowest PE ratio, followed by financials. Projected 5-year earnings growth rate. Obviously, the more growth, the better. Energy leading the way there. I guess they think energy prices are going to go up. And you can see discretionary too. That seems kind of optimistic to me. Price to book is a valuation measure. So again, lower to better. Financials has the lowest. The highest is tech. Long-term debt to capital, so just a financial leverage ratio. And again, lower the better. You want less leverage. And you can see energy has a less leverage, less amount of debt. Telecom, staples have the most. Add it all up, and we kind of rank them. And financials still look really well on valuation level. They've corrected kind of year to date. We had a huge run last year, but they're still cheap price to book. Regulations are starting to fall off. Things that Obama did by signing, they weren't laws. He signed administrative orders. President Trump's starting to rescind some of those. That should help the industry. And really what we need now is the yield curve to tilt up a little bit. Today, after the announcement, the yield curve actually flattened a little bit, and financials still went up, so I consider that a good sign. So we really like financials. It's probably number one sector. Energy I throw out because who knows what energy prices are going to do? Anyone? I really don't know, so it's hard, so we throw that out. Healthcare is really cheap. I would consider that our favorite value sector. Got beat up so much last year in the political climate. That's where the value is, we believe. And you see tech's falling down a little bit. Tech needs to correct a little bit. We think it's going through that now, and it'll be good. And you can see utilities, telecom, real estate, and staples relatively low on the chart. There's still a lot of investors hanging out in their sectors, using them either as bond equivalents or they're a little nervous about the market, so they're kind of driving up the PE ratios in those safer sectors. So we still believe that you should tilt towards growth, even though we think value is probably going to catch up a little bit. And towards cyclicality, because we do believe the economy will pick up in the second half. Real quick on countries. USA, best performer over 10 years. The light blue bars are emerging markets, Brazil, Russia, India, China. You can see it's kind of all or nothing in emerging markets. You can see kind of Southern Europe has had a tough time over the last 10 years. If you dial into 5 years, emerging markets definitely kind of falling behind. A lot of that has to do with the strength of the dollar. It's hurt returns overseas. And in general, you've kind of hurt yourself over the last 5 or 10 years if you've diversified overseas like you should. One thing I noticed, and this is kind of new, is you see Southern Europe, particularly France and Spain and Italy a little bit, have really started to recover. They did so poorly and they're now finally recovering. What do the countries have in common at the bottom? Brazil, Russia, Canada, Australia. They're all heavily invested in commodities. Their large cap stocks are commodity-based, energy and commodities. Okay, 1 year. Look at emerging markets. A lot of this has to do with the dollar. The dollar stopped strengthening. In fact, it's weakening a little bit, and that really helps your returns overseas. And we see that continuing a little bit. Let's talk about valuation. See the S&P 500 over there, about 18 times earnings, forward earnings. Pretty decent growth rate. If you look, emerging markets, much lower valuations, much higher growth rate, potentially a lot of value there. Of course, there's risk, and you've got to worry about the dollar, but there's probably a lot of opportunity there. And in fact, year to date, that's the best performing area. Foreign stocks are outperforming in general over the United States, and emerging markets are outperforming over developed. You can see Japan, it's cheaper than us, it should be. And then finally, you've got Europe, a little bit cheaper valuation, and look at the growth rate. A lot of that 25% is just the growth in the last year is just really low level, it's taken off. So we really think you should tilt your portfolios to more foreign stocks than you have in the past. And a lot of people that are kind of passive, let's say you started out with a 30 or 40% foreign weighting over the last 5 or 10 years, your weighting's a lot less now because of the underperformance. I think it's a good time to rebalance that. Jumping around here a little bit. You can call this whatever you want. Some people call it the Fed model as far as it's just measuring bond valuations versus stock valuations, which asset class is better. The blue one's easy. It's just a 10-year U.S. Treasury yield. I think, would we close at today? 2.1, roughly. The orange one's a little more complicated, not too bad. It's earnings yield, not dividend yield, but earnings yield. It's earnings over price, the reciprocal of the PE ratio. Going backwards, it's about 21. So we're going to be conservative rather than using the 18.5. That gives you about a 4.5% versus the 2.1. I think it's 4.6. So you got a 2.5% gap. That gap gives me comfort that as the Fed raises interest rates and as the 10-year goes up, that we're not going to have a problem with equity valuations. The issue with higher interest rates is what does it do to the economy? What does it do to corporate earnings? And the Fed's been very, very diligent in not raising rates too fast. So I think they're conscious of that. If you look, it's only been the last 15 years or so that stocks have traded cheaper than bonds. If you go back all the way back to 1970, they're pretty well correlated. They're pretty tight. So, I mean, the bottom line is interest rates are artificially low because the Fed's got them there. They will catch up over time, but I'm not worried about that from an equity valuation standpoint. Two measures we use a lot for valuation, whether it's on the ETF side or the unit investment trust side, are price to book and price to cash flow. Price to book, we're dead even, so how are stocks doing versus a 20-year history? Price to cash flow, we're at about a 10% premium. So that's where I say that stocks aren't necessarily cheap here. They're probably about where they should be. I'm not too concerned about the 10% because of what I said at the beginning. Unemployment's low, inflation's low, growth is decent, volatility is low. We should probably have about a 10% premium. So stocks are probably about where they should be. Future gains are really going to come to where the earnings growth are and kind of beating expectations. This is a chart I show mainly to a retail audience. It just kind of shows you where we're at. The red line is just a 9% theoretical compounded return on your investments. No risk. Who would sign up for that product? We could sell a lot of that product. Unfortunately, you have to get on the S&P 500 to get that, and that's the jagged blue line. The numbers don't quite match what we're at today because it's reinvested dividends. But if you look, we got way ahead of ourselves during the internet bubble in 2000. You see again before the housing collapse, commodity housing bubble in 2007, 2008, we're way above the line. Great Recession, way below the line. And now we're a little ahead of the line, but not too bad. Now, of course, you could draw different lines, right? If I drew a 10% compounded growth rate, we'd be undervalued. If I drew an 8%, we'd be way overvalued. So it kind of depends on where you kind of fit in the line to kind of where we're at. But I don't think stocks are overvalued here. They're not undervalued. You kind of have to go to where the growth is and what your belief is on the economy. Are things getting better? Then you should be longer than normal for equities. If you think things are getting a little bit worse, you should probably pull back a little bit. With that, we can open up for questions. Yes?
Can I ask, what's your sell-discipline like? You're saying that the market's not like overly valued. You're not saying it's undervalued. What's your sell-discipline at this point?
Okay, so selling is probably the hardest thing you can do, much harder than buying. Fortunately, I don't have to worry about that too much. On the unit investment side, our products are set and go. They're either 1 year, 2 year, or 5 year products. So we set a basket of stocks, and then we keep them that way. And they go up and down depending on the market. So if a stock does better than the rest, it's worth more than the rest. On the ETF side, most of it is passive. We have a product line called Alpha-X. It's probably the first smart beta product. And again, that's done by multi-factor models. It's all done by algorithms. It updates quarterly based on the algorithms. I don't have to worry about selling. But yeah, selling is a really hard thing. So I'm kind of glad it's taken out of my hands a little bit. Yeah. Other questions? Yes.
Many distinguished investors over the years have said selling is the most dangerous thing you can do. For someone who's observed bull and bear markets for the last 50-some years, I can verify that. A bubble in the late 60s, which took 16 years to overcome. And of course the 90s, the biggest bubble of my lifetime with the tech stocks where there were no earnings, there were only hopes. And it seems every generation we get something like that, whether it's 25 or 30 years. Enough time passes so that people forget the volatility and the danger. It's interesting to me that now the latest surveys show 44% of investors, and I think it's professional investors, think that we're overvalued and we're going to have a fall. We did not have surveys like that in 1999. We didn't have surveys like that in 1969. So in some ways, that's encouraging to me as a long-term investor.
Yeah, I like the fact that a good percentage of the people think that we're overvalued. The problem is when everyone thinks we're not, everyone thinks we're undervalued, then you got an issue. When everything looks great. The top of the internet boom, everything looked great. And I remember, I had huge gains personally in Cisco and Dell through the 90s. And you know why I didn't sell? I didn't want to pay taxes. Always be willing to pay taxes. Just, that's a dumb reason not to sell. Because all of a sudden you don't have a gain anymore. Yeah. Anything else?
Where are you seeing flows now in terms of your products sort of at the edge? You mentioned smart beta, multi, of course, low volatility was hot, dividend yield, and you had an interesting product based on the value line, dividend, I think.
Yeah, I mean, we still see an unbelievable thirst for yield. I call it looking for yield in all the wrong places. Just because of where the Fed's at, they're at 2, and I can't tell you how many, whether it's an advisor or a wholesaler or a retail client, I just want 5% risk-free. Well, that doesn't exist. You've got to take some kind of, risk to get that. And we have a ton of dividend products. We have 20 or 30 UITs that are all shapes and sizes of dividends. So I still think there's this emphasis on dividends that people are looking too much at that. Sean, what's hot? What do you find in the field that's real hot right now that people are throwing money at?
Sure, we're seeing a flow toward Europe.
Definitely Europe.
European dividend ETF, 30 stocks with a yield of about almost 4.5, and the average P is around 14. Where if you compare that to your domestic dividend ETFs, you got a yield of 2 and change with a P of 21. So that's a big difference. Developed international. And then the sectors, we're seeing financials, community banks, we're seeing flows toward. Biotech again, once more, faded for a while, but that's becoming interesting again. And then always tech.
Yeah, your
internet index.
Yeah, your typical retail investor, which is what our products typically go to, chase performance. Yeah. So, I mean, that's just how it goes. I'm not as worried about Europe. Europe was on the cover of Barron's, 2-3 weeks ago? But it's so cheap and it's been undervalued for so long, I think we got a ways there. But you can tell, I'm trying to think, it was a year ago or 2 years ago, we have a cybersecurity ETF, and we sold a couple $100 million of it in UITs. And the cybersecurity stocks are just out of control. So we get different ways. At the top of the internet bubble, we had products as narrow as fiber optics, and that's how narrow it got. We had a biotech product called genomics and proteomics. I call it the Good and Plenty Trust, GNP. We raised $300 million. This is like a week before the top, like March 1st of 2000, like right before things crashed. So we're nowhere near that right now, which is good. Trying to think what people don't buy. A lot of people ask me what isn't selling, because that's, and just kind of plain vanilla, like industrials, things like that, no one really wants.
We're seeing flows out of sector rotation, which is kind of funny because it's keeping pace with the S&P this year, where last year it did poorly. So people are kind of selling it after reviews and unhappy with what happened and not looking at what it's doing right now. So sector rotation, we're seeing flows out of, but it tends to be doing pretty well right now.
Yes, sir.
So today, utilities were up pretty nicely, and my recollection serves me correctly, on days where Fed hikes, utilities have strong days. I mean, is that just coincidental, or very counterintuitive in my eyes? What is it?
Yeah, I mean, on the 10-year, I think we were flat or down a little bit. So they actually, even though they raised, that was kind of baked in the cake already, and they kind of backed off And our economists think they're going to raise twice this year, but if you look at the odds, they actually went down below 50% for one rate. So I think after today's meeting, the odds of future rate hikes went down, and that's why utilities went up. What's strange is that financials went up. They were way down before the meeting, and they ended up about flat. So I still can't really figure why that happened. I think part of it's just a rotation out of tech into financials, what we've seen last week. Yeah. All right. Thank you very much.
Thank you very much, John. Dean, a question?
Thank you, Phil. Dean Speranza. Question for Brandon, please. When you were up, you talked about perhaps explaining why Facebook and Tencent are not only good businesses, but are presently good investments. And if you would also please mention what's the multiple of your portfolio right now?
Sure. So, yeah, I'll take the last one first. The multiple in our portfolio as of March 31st, again, looking forward multiple, was a bit over 20 times. And we think the portfolio as a whole will grow about 15, 17% in that range over the next 3+ years. If you compare that to the different benchmarks, say the Russell, that's our primary benchmark, the Russell 1000 growth. It's about just under 20% premium to the Russell, but we think you're getting all this excess quality with our portfolio versus the Russell, so we always feel like that gap is too low, that premium's too low. And then on Facebook and Tencent, was your question more how do we get comfortable that based on those valuations?
How's the valuation? Why is it right now?
So Facebook, I talked about how based on all the factors I discussed, we think it's going to grow earnings at least 25% over the next few years and long tails thereafter. Facebook today on a forward basis, forward 12 months, is a low trade, valued at a low 20s multiple. But then they have all these other assets that I didn't have time to get into, but that we value, such as WhatsApp, Facebook Messenger, Oculus, which is a virtual reality platform. They have a search advertising opportunity. They have a ton of cash on the balance sheet. We give them credit for some of that. So when you factor all that in, we think Facebook is actually valued at more like a 20 times multiple forward earnings. 20 times multiple for a company that we think is going to grow at least 25% on the bottom line over the next few years with long tails is too cheap, we believe. So that's kind of the work we do. We pair the growth with what we have to pay, and we want to see at least strong double-digit returns going forward. And very similar for Tencent.
Jim?
Question for Brandon. Do you analyze earnings quality, accounting differences, and if so, what do you?
Yes. So we very much look at earnings quality. And what we do is we assess the business and we only value what we think are recurring earnings. So for example, if there was something in the current year that was one time, we think one time in nature, we will back that out. If we think the company, on the flip side, if we think the company's under earning for some reason, and we think that's temporary, we might give the company credit for having higher margins today than their GAAP numbers reflect. So we're always doing our own proprietary fundamental analysis on these businesses and valuing them based on the growth we see in the company, which is often very different than the reported numbers.
Any questions from John? Since he had his primary degree in computer science, I wondered if you were involved in quant or the development of some of the quantitative-oriented products at the firm.
Actually, I'm on the fundamental qualitative side, so
Right.
even though I have that kind of background.
Good. Well, both Shakespeare and myself would like that. Quant's a useful tool. Okay. I thank everyone for coming and supporting your society, and we hope to see you frequently in the coming year. If you have suggestions for programs or candidates you'd like to suggest, please don't hesitate to mention them to the new president, Christina Worley, the vice president, or the program chair, myself, as well as other directors. Our strength is in our team, our network, and we don't want to be in silos. And we know, in especially times of stress or uncertainty, we try to do more programs, including socials. Mentioning socials, you'll hear about those in the next couple of days. Also, the handouts from the presentations tonight will be arriving in your email inbox in the next day or two. So there's a lot to chew on. I thank again our two wonderful panelists, and we're very pleased to have them with us and to have a homegrown person who's grown up and, you know, doing great things as an adult and overcoming the prejudice toward, you know, people that are accountants or bean counters. Clearly understands culture. So thank you both very much. Ladies and gentlemen, good night, good luck,